In 2022, global financial markets suffered one of their most painful years in decades. Stocks fell, bonds fell, crypto collapsed, and for many investors, it felt confusing because the economy wasn't crashing in the traditional sense. So what actually happened? This is the story of the 2022 inflation and rate hike crash. The roots of the 2022 crash begin with inflation. After the COVID pandemic, economies reopened rapidly. Consumers were spending again, but supply chains were still strained. Factories, shipping routes, and labor markets struggled to keep up. At the same time, energy and food prices surged, and Russia's invasion of Ukraine intensified global supply shocks. The result? Inflation reached levels not seen in around 40 years. In the United States, consumer inflation peaked at 9.1% in June 2022. In the UK, inflation hit 11.1% in October, the highest in over 4 decades. High inflation erodes purchasing power, squeezes profits, and creates uncertainty. Markets don't like uncertainty. To fight inflation, central banks took decisive action. The U.S. Federal Reserve, Bank of England, and others began raising interest rates aggressively. In the U.S., rates started near zero in early 2022. By December, they had risen to 4.25–4.50%. This was one of the fastest rate hiking cycles in modern history. Why does this matter? Because interest rates act like gravity on financial markets. When rates rise quickly, asset prices tend to fall. As borrowing became more expensive, the impact spread across markets. Tech and growth stocks were hit especially hard because their valuations depended on future earnings now discounted at higher rates. Cryptocurrencies collapsed, with several major crypto firms experiencing severe distress or outright failure. Housing markets slowed sharply as mortgage rates surged. Bonds, traditionally seen as safe, suffered unusually large losses as rising yields pushed prices down. This was rare, stocks and bonds falling together, and it left investors with few places to hide. As rate hikes continued, a new concern emerged. Would central banks push the economy into recession? Markets began pricing in the risk of a hard landing. Companies revised forecasts downward. Valuations compressed, even for profitable firms. Importantly, this wasn't panic over banks failing or the financial system collapsing. It was fear of policy tightening going too far. By the end of 2022, the S&P 500 was down about 19.4% for the year. The Nasdaq fell roughly 33%, and a traditional 60-40 stock-bond portfolio suffered one of its worst years in decades. The decline wasn't sudden. It was slow, grinding, and persistent, wearing down confidence month after month. Unlike 2008, banks remained largely stable. There was no housing collapse, and the financial system didn't break. The 2022 crash was driven by one central force, the rapid repricing of money itself. After years of cheap money, markets had to adjust, quickly, to a world where capital once again had a cost. The biggest takeaway from 2022 is simple but powerful. Interest rates matter, a lot. When rates rise fast, asset prices fall, speculation unwinds, and leverage gets punished. The 2022 crash wasn't about fear of collapse. It was about adjustment, painful, necessary, and unavoidable. Market crashes don't always look the same. Sometimes they're sudden and chaotic. Sometimes, like 2022, they're slow and relentless. Understanding why 2022 happened helps investors recognize risks, not to predict the next crash, but to respect how markets respond when the rules change.